I think I saw a question come in. Jen, we got something?
We sure do. This question is from Hess asking for early stage investment. Can you explain promissory notes and other alternatives and their benefits? Which is best for founders to not shoot themselves in the foot later down the road? And is there a preferred solution for the founders and the investors?
Perfect. Great question. Thanks very much for asking that. Let's talk about investment vehicles. This is the general rule of thumb. Use whatever the investor is comfortable with, unless you have the power to dictate how those terms go. That's something that founders shoot themselves in the foot way too early in the game. They sabotage themselves because they say, I will only use this instrument. Case in point, the SAFE instrument, Simple Agreement for Future Equity, was created by Y Combinator and now is used by a lot of startups. Back in the day, when I've raised money, and this was even in 2018, 19-ish, and I was raising capital for a venture, the investors that we were talking to, high net worth individuals, had no idea what a SAFE was. I told them, this is SAFE, and they're like, what? I don't get shares? I'm like, no, it gets kicked down the road, etc. And it didn't work, so we ended up just selling equity. There's no such thing as a SAFE in their mind. Even my co-founder was like, I don't get SAFEs, and we fought, and we ended up in a very, very ugly divorce situation. So you have to understand that investors need to feel comfortable, and typically what instrument they're willing to invest in will depend on their sophistication. Real solid pro startup investors, I'm talking gurus, will invest using a SAFE with a valuation cap and nothing else. And I'll explain all the different instruments, but I want to set the context here. Why? They know the game. When I'm writing an angel check, which pretty much I'm going to write an angel check soon, and I'm just going to write it as a SAFE, Simple Agreement Future Equity, give me a valuation cap, probably not even valuation cap. I like discounts actually, because it really makes the founder push for their valuation in their next negotiation. There are other terms out there, and I'll just say, yep, here it is. No deadline, no interest. Let me know when everything is up and going, and let's sign the SAFE agreement and let's move on, because we've got better things to do. That's because I'm a founder, I'm an investor, I've been a general partner, I know how these checks get written. I have seen this game over and over again. But another investor may say, I want to do equity because maybe they got rich selling Bitcoin or they flipped a house. They're your rich aunt and uncle. They're going to say, I need to know I have 10% of your company, et cetera. So you as a founder, you're going to have to work with them. And remember, you can have different investors all use different types of instruments, and that's okay. That's what you can do. So let's go through the instruments that I would recommend. So the first base one, which is least recommended, is selling equity. You give me $100,000, my company is worth $1 million, therefore you're going to get 10% of equity. The problem is, how do you know your company is worth $1 million? Like, how are you going to know? You're not going to know whatsoever, right? So what you want to do is you want to kick that valuation conversation down the road and say, we don't need to value my company. Let's value it when we're ready. Therefore, a convertible note or a SAFE comes next. Downside of equity is that you have to argue over a valuation, and you don't know, and founders, you're not going to know. You are sitting on a hyper growth potential unicorn startup. There are so many factors that go into valuation. You don't know. It's not like you're valuing a Subway franchise or some type of mom and pop shop like a pizza store in New York with reams of data. If you're doing something disruptive, you can't do that. The next thing that you're going to go to, because equity is simple, people do it in their heads and they go, I get it, $100,000, $1 million valuation, I get 10% of the company. Investors are smarter, and if they're simple that way, they're going to want the simplest path. But the next step is something called a convertible. And I'm giving you all the steps because understanding equity, convertibles, and SAFEs will help you go up and down the ladder. You want to think about a convertible as, this is a debt. You are lending me money, and I am going to build this company, and I'm going to convert the money, my debt, into equity later on. Now, what's cool is you've got some options. I've used convertible notes where I've said, I reserve the right to pay you back your money with this amount of interest, and we walk away. I'll pay it back to you by the end of the year, short term. So they basically loan me $100,000. I say that I will pay you 10% interest, 15%, whatever it is, by the end of the year, and it'll keep rolling. And that's what I owe you. Then a convertible note has something called a conversion event. There's an event. And that could be something as simple as you raise $1 million, or you sell the company, or you do a price round, is really what it boils down to. So later on, your $100,000 that I owe you, the clock is ticking, you'll get 10% on your money, and I may reserve the right to just pay you out. I've done convertible notes, and I believe we've done some of these here at startups.com, where we say we are only going to convert you to equity if we actually take in venture capital funding, something like that. That gives everybody an out, and the interest rate, if it's good enough, then great. So let's say you give 20% interest because you want to reserve the right to buy them out. They could be happy with that. 20% a year? That's an amazing, amazing return on investment. I work really hard to make 20% of my money by trading my capital, et cetera. But returns are usually not that big. Hedge funds, I think, average their return is 14% for the ones that actually make you money back there, right? Most hedge funds, unless you're in the top 1%, lose money and all these things, right? So 10%, good deal. 20%, amazing deal. I'm going to pay you back. But if there's a conversion event and I sell the equity, you get equity, $100,000 of equity at a specific price, and it's all baked into the contracts. Why could this be something that you want to use? One, investors understand. It's kind of like the middle road. They understand timelines, they understand interest, return on investment, and they could be happy with that. And I'm going to tell you a reason that startup investors hate convertibles, okay? They can't stand them because they're not interested in those types of 10%, 20% returns. So remember, it's the type of investor that you are working with. Investors may like convertibles because I understand it, and you may like it because it gives you an out, and you can use that. So if you got something where, listen, you're just going to generate cash flow right away, it's one of these instances where if your company can generate cash flow sooner than later, you may want to get the investors out. Like, let's just get the investors out of here and put that in the contract and say, maybe you can roll it in. I've done deals where I said, you have to take your money out at the end of the year when I pay it all back. You have no choice whatsoever, and we're going to renegotiate. Now, you have to have some serious negotiating power to do that, but I've been in some really high cash flow situations. So now you've got convertible. Now let's move to the next one. Let's move to SAFE. A SAFE is basically a convertible without the timeline, without the deadline, and without the interest rate. And the reason you don't want to do that, you don't want to put a timeline, like put a date on there, is because what happens is startups, who knows how long it's going to take. I've seen founders raise money on a convertible note and they've shot themselves in the foot. They get sabotaged because what happens is the investor says, you owe me $100,000. I'm calling the note at the deadline. A demand letter gets sent in, and now you're in breach. If you can't pay that back, you have to go back and negotiate. And you say, all right, well, I don't have the money. And the startup could shut down. The investor could put so much pressure on you that if you don't pay back, there's legal action, et cetera. And a lot of times I've seen startups get shut down because the investor comes back and says, okay, it's been a year. You are not growing fast enough. We're calling the note. And then you got trouble. I've seen a lot of startups, like I said, really put between a rock and a hard place. I've seen Shark Tank investors, Shark Tank, the people that you see on TV, completely hold a startup hostage because of convertibles. So a SAFE is a very friendly way that you can convey information, you can make a decision, and then boom, here's what happens is they say, all right, let me know when you go to the next round, and then we'll deal with the equity there. Because what happens? You put in a note or a SAFE, and it's got no terms other than valuation cap. Let's say the startup is valued at $10 million. The cap is $10 million. And I put in, let's say $1 million. Let's just make round numbers. Now you owe me that money, but we're not going to worry about the valuation, but I'm going to put a valuation cap on it. Now what happens is, let's say at your next round, at the seed round, or let's say you do an A, you are selling at a priced round and you get a valuation of $10 million. Well, my capital gets converted to 10% of the company, $1 million, $10 million valuation. Bob's your uncle. Then you send me my shares and I am now vested. I've converted. But let's say that the next round, your valuation is $5 million. Well, guess what? I get double my equity. It works great for me because I put $1 million, you're $5 million. Now I own 20% of the company. You have to write me the shares if you raise it. So that means you want to push hard for your valuation to skyrocket. But if you go and you get a valuation of $100 million, my million is only 1% of the company. I'm like, that's not cool. I was one of the earliest investors. I should get to the cap. I will still get 10% of the company. Right? And that's where things get a little janky. This is the reason Y Combinator does two SAFEs, puts in money in the beginning and says, okay, we want 7% of your company, etc. And then they do another SAFE at most favorable nation. This is where the best terms possible, they get to convert their other, whatever it is, $250,000 or whatever they're going to do at the most favorable terms in which you've sold at that moment in time. So you want to make sure as a founder, these are the factors. Let me go back and let me summarize here. You want to think about your investors. What is their sophistication? You want to think about the stage of your startup and when you're going to be generating revenue. And you want to be thinking about what type of investor that you want and when you think your exit is going to be. If you need to go A, B, C round because you're in one of these hyper growth startups that needs capital to grow, then you definitely need to be using safes. That's just what it comes down to. But you may not be so lucky. Beggars can't be choosers, everyone. So you may have to do one deal. I know a founder, the one who did crowdfunding, he ended up raising his first 50K, I think, and he gave like a 50% discount on his first convertible or his first safe. Why? He needed to get that first $50,000, that first pickle out of the jar. You'll always hear me say this expression. So he could go to the other investor and say, I got my first 50K, now let's do it, and pay for his crowdfunding and all those things. That's how you want to figure out what instrument is best for you. And you have to have a balance. There's always tension. One, do I take the money now and potentially shoot myself in the foot in the future and give away all my equity? Remember, founders, when you get to these later stages, an investor is going to make you defend your cap table. They look at your cap table, and if you did some really nice deal, I had founders say, oh, I set aside like 20% of my company for my wife and my kids. I said, do you want to raise money from serious investors? And they're like, yeah. I said, they'll get rid of that. As an investor, going to say, what are we going to do? We don't have enough cap table to go around. You're going to defend your cap table. That includes co-founders, employees, how generous you are with your options, etc. You're going to have to defend that. So don't shoot yourself in the foot in the short term. Think of it long term and think strategy. Well, at the same time, there's that tension. You might have to do a one-off deal, and investors will understand. An investor will look at the first 50,000 and you say, I had to give a 50% discount because I need to raise that first money, but look at me now. Investors go, okay, I got it. And there are other things investors will do. Later on, when they put in more capital, they may force you to have what are called follow-along rights with your first smaller investors. And they may say, you know what? You have to make sure all these investors in the beginning sign this agreement before I put my $5 million in. A follow-along rights, and there's pro rata, there's all these different things. And an investor, an institutional one may say, when we want to sell, none of your other investors in the beginning can hold us up. They have to agree type thing. And everybody signs. And that's where things get really sticky when it comes to raising capital. Let me end with this. If you are out there raising capital, there are two things that you are thinking about. You're thinking about the funds and the terms. Two things. Pick one. You get to win on one of them, not both. Most founders lose on both, but you get to win on one. You don't get to win on both. Here's what I'm saying. Say you're raising $1 million and the founder comes in and says, I need $1 million. And the investor says, okay, I'll give you that $1 million, but I want my terms. What do you do as a founder? No, you don't get your terms. They're my terms. Well, then I don't need to give you my $1 million. So you're going to lose on the terms. You're going to sign all the terms that you want. Beggars can't be choosers. You're going to sign away control. You're going to sign away board seats. You're going to sign away all sorts of different things, right? Now, let's say you don't need the money and you can dictate terms. Well, guess what? Take less money. And sometimes you can say, listen, I only need $100,000. And you don't get that much equity ownership and you only get the board seat for the first year or something along those lines. You could do that. But if you want your terms, you're going to get less money. If you want more money, you're going to play by the terms. And that's the rock in the hard place, which is the reason you want to build a startup that creates FOMO, generating cash, preferably profitable. That's what you want to do. So you put the power dynamic. I've got a YouTube video coming out on this pretty quickly. It's titled Why Investors Lie to You, or They Lied to You, or The Investors Lied to You. It's going to be a clickbaity title. It's going to be awesome. But you want to make sure that you get the power dynamics on your side so the investors are courting you. Wait. Can you take $5 million? And we'll take less money. Will you do this? Will you do that? And that's where the bidding wars happen. And that's a great place to be. I bid in that spot very, very few times where a company said, don't go and raise money here. We'll give you better terms. And in fact, let's just buy you, right? And that's how I exited one of my startups. That's what we got. That's the great question. Thank you for asking that.